Hey, what is up everyone? Jin Hao here, back with another stock trading video, and in today's video we are going to talk about how you can potentially make profit from a bear market like where we are right now with a tool known as Inverse ETF. If you're into it, let's move on. So as usual, disclaimer, I'm not a licensed financial advisor and I'm not licensed to give you any advice right over here. So information shared and mentioned in this video are not financial advice and they are just for educational purposes only. I'm just a random guy with, a camera on the internet, so do your own research and due diligence before putting your hard-earned money into the market. And also, there are people who are pretending to be me in the comment sections. So this is now my comment will look like. You see my name with the border and there are no weird characters in the name. And this is what an imposter's comments will look like. They have weird characters in their names and they will ask you to add me on WhatsApp and Telegram. I will not do that, so be mindful about that and don't let those imposters fool you. And alright, now let's move on to the meat and potatoes of this video. Now, before I explain what an inverse ETF is, let me give you a crash course on what is an ETF, a normal and ordinary ETF. An exchange-traded fund or ETF is a basket of securities that trades on an exchange just like your ordinary stocks. The popular ETFs that we always mention in this channel is Index ETF, which refers to ETFs that track the movement of a certain index. For example, SPY, the full name SPDR S&P 500 ETF Trust. Mouthful of that, right? Which is an index ETF designed to track the S&P 500 index that we are all familiar with. Another example would be the Invesco QQQ Trust, which is an index ETF that tracks the movement of Nasdaq 100 index, which is essentially the top 100 companies listed in the Nasdaq exchange. These index ETFs are basically designed to track the movement of the underlying index by buying into the same exact stocks at the same weightage so that the performance of the index ETF matches the performance on the index that is being, benchmarked in this case. Inverse ETF, on the other hand, is designed to move the opposite direction of the underlying benchmark, and sometimes it is leveraged as well. For example, there are 3x or 3 times inverse ETF for the S&P 500 index, meaning that for every 1% drop of the S&P 500 index, the 3x inverse ETF will move up by about 3%. So to achieve this effect, inverse ETFs are constructed by using derivatives to profit from a decline in the price of the respective underlying benchmark. So essentially, inverse ETFs allow traders like you and I or investors to profit when the market or the underlying index declines without the need of short selling. Now, this brings us to the advantage of inverse ETF. To profit from a decline of an index, you have to short the index futures, short the ETF, or buying into an inverse ETF. Now, shorting the index futures is a completely different game because that involves futures, and it is highly leveraged and difficult to manage for a lot of, inexperienced traders out there. Shorting the ETFs is just like shorting stocks. You need a margin account from your broker. Technically, you can lose more than the capital you have put in with these two options. Now, however, with inverse ETF, you do not need a margin account because it is just a normal long position. The only thing is some brokers out there might require you to apply for trading permission before they grant you the permission to trade leverage and inverse ETFs. And technically, you will not lose all your money even if the trade go against you. One thing I have to mention and emphasize is that because the way inverse ETF is being constructed, it is not the right tool for you if you want to hold it for long term or even mid term. This type of ETFs is more suitable and it is designed for short term holding or day trading only. The reason is because of the high expense ratio, because to achieve the leverage movement on the opposite direction, derivatives are being used, and these derivatives have to be renewed progressively as they have expiry, because they are basically just contracts, as opposed to normal ETFs whereby the fund managers just have to buy the stocks in proportion in the correct weightage and hold them. They have to do some rebalancing from time to time, no doubt on that, but the expenses are definitely a lot lower than renewing those derivatives contracts every single month or every quarter. And also, the issue of tracking error is also more pronounced in the world of inverse or leverage ETFs due to the way it is constructed. Sometimes a 3x inverse ETF may move only 2.5% or even 2% a day, even if the underlying declines 1% during that single day. Or they can move more than what they are supposed to. So just keep that in mind. Here I'm going to share with you the inverse ETFs for the three major indexes in the US, which are the Dow Jones Industrial Average, S&P 500, and the Nasdaq 100. There are a couple of choices when it comes to inverse ETFs as well. Just like normal ETFs, you get the similar offerings from different issuers. What I will do is providing you the one with the higher AUM, or the one I trade. And after that, I will share with you which one are my primary choices, which indexes I usually go for, and whether I go for the 1x inverse or the 3x inverse. Because, well, it would be ridiculous to buy all of them even if you have strong opinions that the market will go down. Alright, so let's begin with the inverse ETF without leverage, which is also known as the 1x inverse ETF. For the Dow Jones, it will be ProShares Short Dow 30, ticker symbol DOG. For S&P 500, that will be ProShares Short S&P 500, ticker symbol S#. As for the Nasdaq 100, it will be ProShares Short QQQ, ticker symbol PSQ. For these inverse ETFs, every 1% decline in the underlying index will make them go up approximately 1%. So if you buy into any of these inverse ETF and the index goes up, for every 1% the index goes up, you lose about 1% as well. Now let's move to the 3x inverse ETF. For the Dow Jones, that would be ProShares Ultra Pro Short Dow 30, ticker symbol SDOW. For the S&P 500 index, the 3x inverse would be ProShares Ultra Pro Short S&P 500, ticker symbol SPXU. And for Nasdaq 100, the 3x inverse is ProShares Ultra Pro Short QQQ, ticker symbol SQQQ. And just a side note, this is the highest AUM among all inverse ETFs. Alright, now let's get into the next part, which is my personal preference as well as my personal practice. Again, no financial advice here. When it comes to trading inverse ETF, the primary goal is to profit from the market when the market is trending down, aka bear market. I wouldn't go all out into inverse ETFs even if the market is very bearish, because the market can rebound, faster and greater than what we usually thought. Inverse ETF is usually one of the ingredients of my overall trading portfolio. I will still trade stocks or their options in the bear market because there are still going to be plenty of stocks that are performing well during a bear or uncertain market. I've already made a video on how I screen for trading ideas in an uncertain market. I'll link that up in the top right corner, the YouTube card, and also description below for you to check out. Now, even if the market does not give me any stock to trade, or I happen to miss the entries, I will not use all my capital to get into inverse ETFs as well. Proper position sizing is still vital as far as trading is concerned. With that being said, my preference would be going to the 3x inverse ETFs, primarily the S&P 500 and the Nasdaq 100 3x inverse ETFs, which are SPXU and SQQQ. I wouldn't necessarily go to the Dow because it's easier to focus, and I don't see the point of further diversifying into Dow's inverse. If the market were to drop, they will all drop together as they are pretty much correlated. So I just think that 2 is the sweet spot right over here, at least based on the way I manage my trading portfolio. As for the reason why I go with the 3x, it is because of the efficiency when it comes to utilizing my capital. I can have 1/3 of the position size of the 1x inverse to achieve similar performance, which means I use less capital to achieve the same result that the 1x inverse can. And I can preserve the capital for other purposes. For example, I can have the flexibility to add positions should the market continue tanking, or I spotted some stocks which, with nice trading setup that I want to tap into. So in short, with 3x Inverse ETF, I can preserve the capital for more flexibility later without sacrificing the potential of, as compared to the normal 1x Inverse ETF. Another question that people might ask is whether I hold overnight for such positions. Now, if you search online about it, most people will discourage you from holding it overnight. Now, technically, maybe you shouldn't, all right? But from my personal experience, I have no problems holding them overnight for a couple of days to maybe up to 2 weeks to ride a short wave in that case. But understand that tracking error would be there, which means if the market drops 3% in a week, for example, you wouldn't necessarily make exactly 3% gain or 3x of 3% if you're in the 3x inverse. The margin of error is larger than usual. Just keep that in mind. Alright, so that wraps up this video. Again, no financial advice here in this video. Do your own research and due diligence when it comes to, trading such instruments. Understand the risk involved and always trade with proper position size and in moderation. With that being said, if you get benefits from this video or you enjoy this video, please gently tap the like button under the video for the YouTube algorithm. Subscribe if you want to see more content just like this one, and turn on the notification bell so that you do not miss any new content. As usual, thanks for watching, and I'll see you when I see you. Peace out.